All right, so today I want to talk about interest rates and the multifamily market. So we're talking duplexes, fourplexes, 10 to 20 units and up. So interest rates, they're higher, everybody knows, and so the cost of a mortgage payment on a typical $400,000 home in Central Valley, California is now $400 or $500 more than it was 4 months ago. So the big question is, what is this going to do to the multifamily market? Well, let's look back a little bit. The price of homes have exploded, of course, in 2021 and early 2022. Since last year, the price of homes have grown like 20% in most markets. Since 2020, prices have skyrocketed 38%, even higher in some markets. It's insane. So are we in a bubble? Well, I'll tell you my sincere belief, we're not in a bubble. Could apartment buildings drop in price a little? Yes. Are they going to crash and burn? No. I don't think so. I really don't think so. This is why. So things are fundamentally different than the 2008 crash that everybody likes to compare it against. Two main things are loan qualifying and underwriting, still tight. Compared to 2008 or 2006, 2005, non-existent. Check the pulse, you're breathing, okay, you qualify for a loan. That was part of the problem then. We don't have that now. The other item is, and this statistic very important, housing supply versus new household formation. If you look at what was going on in the late 2000s, 2006 to 2010, you had new construction way surpassing household formation. Quite different now. We are in huge demand for housing right now, as we all know. But there's not enough homes and apartments to go around. So are home buyers getting priced out of being able to buy? Yes. How about apartments? Well, yeah, the higher rents are tough for tenants, but you got to live somewhere. If you want to live in California, you're going to pay higher rent. So if you look at the pace of construction from 2008 to 2010, there was way too much being built compared to the demand at the time. Caused a surplus of homes, part of the problem back then. Everybody was jumping on the bandwagon. Let's sell these properties and make a lot of profits. So now we're seeing the exact opposite. Demand for housing entirely outweighs the supply we currently have. Construction slowed down, and it's obvious that it doesn't match the pace of demand. Have you tried getting a building plan approved in recent years? Permits in place? Best of all, leave that to the pros. And even the pros are backing off once they put their construction budget together and see what the cost of materials is. So we are still in a housing shortage. In 2020, 45% of households could afford a mortgage on the average home and needed to make $73,000 annual salary. Nowadays, income needed to invest in an average home is $113,000. So that's roughly 26% of households. So household, affordability, super low. Since the average monthly payment of an apartment rent is now $640 less than a house payment. So multifamily properties are well worth investing in since demand has been high and now under current market conditions will be even higher. Vacancy factors still at record lows. 2-3%. Really? It's nothing. Rent prices still in up-only mode. Well, you get the picture.